This question will walk through the accounting for a defined benefit pension plan. The following information is available for Sunshine Corporation's pension plan for the 2020 fiscal year. We're given the defined benefit obligation opening balance, the fair value of plan assets opening balance, current service cost, discount rate, actual return on plan assets. In this question, we're given the actual return as a percentage rather than as a dollar value, which we haven't seen previously, contributions, and benefits paid. On January 1st, 2020, Sunshine Corp amended its pension plan, resulting in past service costs with a present value of $140,400. Sunshine follows ASPE. And we're asked to calculate the pension expense for 2020 and prepare journal entries to record the expense and funding for the year, determine the balance of the net defined liability or asset reported on the December 31st balance sheet, prepare a 2020 pension worksheet, and identify the December 31st, 2020 plan surplus or deficit and compare it with the asset or liability reported on the December 31st, 2020 balance sheet. We're asked to explain the comparison. And then lastly, we're asked what would happen if Sunshine Corporation applied IFRS instead of ASPE. All right, well, looking at A to C, or even D, A to D, will all be covered through our pension worksheet, and we're explicitly even asked for a pension worksheet. So personally, even if I hadn't been asked for a pension worksheet, I would still prepare the answers to this question in a pension worksheet. It's the best way to control the information in the question and ensure that whatever component you're asked for, you have the correct balance. So let's get started with that. I've set up a pension worksheet here. And you can see that debits will not be in brackets and credits will be in brackets. I've got an items column where I'm going to explain what I'm doing. These accounts here are in the general ledger of the company, and these accounts are not in the books and records of the company, but rather in the books and records of the plan itself. So they're often called memo accounts. The reason that the company needs to know what's going on in the plan is because the company is on the hook to make sure that whatever benefits have been promised to employees under this defined benefit pension plan actually take place. So any shortage in plan assets or any surplus as well can be recorded on the books and records of the company. So they need to know what's going on in the plan. It's really important that we remember in this question that we're following ASPE. So sometimes if I have this pension worksheet for IFRS, I have an OCI column here, but of course there's no such thing as OCI in ASPE. So I've deleted that. So I just have this blank column that I'm not going to use. So I need to really remember that as I'm preparing my answer to this question, because if you're preparing an answer under ASPE, you will get the wrong answer if you're using OCI. And if you are preparing a pension worksheet using OCI, you'll likely get the wrong answer if you don't use OCI. So it's a really important distinction in terms of setting up your columns to make sure that you know exactly where you should be recording things. So let's get started with the opening balances. So opening balance, January 1st, 2020. And we're given the opening balance of the plan assets. Sorry, the defined benefit obligation is $255,000. And of course, this is a credit balance because this is a liability. So 255. And we've got the fair value of plan assets are 297. And assets are, of course, a debit balance. Now, we're not given the opening balance for the net defined benefit asset or liability, which is what the company would have recorded on the opening balance. But we know that the difference between the defined benefit obligation and the plan assets is what the company needs to record. So does this plan have a deficit or a surplus on January 1st, 2020? Well, they have a benefit obligation of $255,000 and they have plan assets of $297,000. So they actually have a surplus. So the company on January 1st will have recorded a surplus of $42,000. So they have an asset on their balance sheet of $42,000, which is to reflect the fact that the plan assets are higher than the present value of the benefits that need to be paid out under the plan. Okay, so we've dealt with these items here. Now we've got current service costs, discount rate, actual return, contributions, benefits. And I'm going to give you a tip here. So what we want to do is we want to think about this from a time perspective. So we just recorded the opening balances of these two, of the asset and the liability. So we're January 1st, 2020. This these entries are for the 2020 year. So we've just started at the very beginning. So let's just think about what would happen next in terms of time. So whenever we're told that these things occur, we can assume that they're year-end amounts, unless it says, for instance, we've seen other questions where it says contributions were paid evenly throughout the year, or even it could say contributions were paid at the beginning of the year. At that point, you'd want to pick that up next. And the reason I say that is because when we calculate the expected return on the plan assets and the interest expense on the DBO for the year, which we'll talk about in a minute, the basis for that calculation needs to be the weighted average balance for the year. So if there's anything that happened at the beginning of the year or throughout the year, it will impact the basis for that calculation. So you'll get the wrong number if you haven't considered what happened at the beginning of the year versus the end of the year. So we can assume that the current service cost is end of year, contributions are end of year, and benefits paid. We can assume that they're end of year because it doesn't say that they were paid throughout the year. But if we look at this one here, there's a note here that says on January 1st, 2020, Sunshine Corp amended its pension plan, resulting in past service costs with a present value of $140,400. So note the date here, January 1st, 2020, really important. We just picked up these amounts that had January 1st, 2020. So we've got another January 1st, 2020 amount. So we want to make an entry for this past service cost. Now, how do we record past service costs? Well, both IFRS and ASPE require past service costs to go through the income statement. And a past service cost means that the corporation looked back at some of their plan members or some of the employees that had been working and said, you know what, we really should have paid out an extra $140,400 towards the plan for these employees for whatever reason. It could be a contractual dispute, it could be a union dispute, it could just be the corporation's goodwill. Who knows? But for whatever reason, there's past service cost here of $140,400. So that's going to be an expense for the corporation. I think it's $140,400. Let's just double check that number. Yep, $140,400. So it's going to be an expense for the company, and it's also going to increase the DBO of the plan because now the plan has to pay out an extra $140,400 in the future. Okay, so we got that. That's helpful. So and I would put, actually, we should put here past service costs January 1st, 2020. Let's make sure we label the dates. Then we've got a current service cost of $63,000. So this reflects the fact that we've had employees working at the corporation for the past year, and they've earned, the fact that they provided that year of service means that they've accrued extra benefits now for their defined benefit pensions for when they retire. So they've earned an extra $63,000. They might not be retiring for an extremely long time, but we still have to recognize the pension expense as the employees are providing the service. And this looks a lot like past service costs here. We're going to have $63,000 as pension expense, and it's going to increase our DBO. And we're going to say this is December 31st. Okay. We're assuming that that was at the end of the year. We're given the discount rate and the actual return. Let's just do everything else first, and then we'll deal with calculating our net interest finance costs at the end. So we've got contributions of $79,200. We can assume those are at the end of the year because it doesn't say. So employer contributions decrease cash from the company and increase the plan assets. So if you think about it this way, the corporation's taking money out of their bank account and putting it into the bank account of the plan. So it's decreasing the corporation's cash and it's increasing the assets. Or you can think about this as a bank account. It might be composed of cash and investments sitting here of this $79,200. And then the next thing we had was benefits paid. Let's say it's December 31st. It doesn't say otherwise, although you would assume they're paid over the year. So 43,200. So benefits paid, a common mistake is to show this as a decrease in cash of the corporation. However, the way that pension plans work is that the corporation gives money to the plan and then the plan settles the benefits. So benefits paid, 43,000, how much was it? 43,200. So this is going to decrease the assets of the plan. So if you think about it, they just wrote someone a check, so their bank account's lower, and it's also going to decrease the future obligations under the plan because we just paid someone 43,200 or paid a variety of people 43,200, which means we have that much less that we need to pay in the future. Okay, so we got that one, we got this one. So we've picked up everything here. The last thing we need to do is calculate, we use this discount rate of 10%. So the discount rate of 10% is given to us by the actuaries, and this is our expected return on plan assets. If you think about it, this is a cash account investments. We're expecting to earn 10% on the balance in this account. And we also have interest expense on the DBO. So if you think about it, the DBO has been present valued, and the way time value of money works is that we've discounted the DBO to reflect the fact that that DBO, let's say that DBO isn't going to materialize for 10 years. Of course, it's going to materialize over time, but let's just think about it simplistically as like an end date. Then as that 10-year period gets closer and closer and closer and closer, we need to increase the value of the DBO to reflect the fact that we no longer have that benefit of the time value of money. It's similar to a bond. When we record a bond at a discount, we need to increase the value of the bond every period so that the bond is on our balance sheet at face value at maturity. It's a similar concept with this DBO. It's been present valued, so it's the time value of money has made it less. As the time period gets closer, we need to increase the value of the DBO. And the offset of those two things is going to be our net interest or finance cost. Now, what's really tricky about calculating your expected return is that you need to think about these dates. And that's because the basis of the calculation isn't just these two numbers. It also needs to take into account anything that happened at the beginning of the year or throughout the year. When things happen at the end of the year, they have no impact on the weighted average because they were only there for one day, December 31st. But if transactions happen throughout the year, which is we've seen examples where the employer contributions happen throughout the year, or even it could say they happened at the beginning of the year, then we would need to be really careful to label that with the right date because we would need to consider the fact that then we would expect to be earning a return on all or a portion of those contributions throughout the year. When these contributions happen on December 31st, they have no impact. But if they happen throughout the year, we would need to expect to earn interest on half of this amount. Now, in this question, we know that these are opening balances here. And we also know that there's this past service cost that happened at the beginning of the year. So plan assets, we can use 297 as the base for our calculation. But for the DBO, we need to make sure we're using the sum of these two, which is 395,400 as the basis for our interest cost. And it did say that the past service costs are also at the present values. They would need to have the time value of money taken into account. So let's calculate the expected return on plan assets. So this calculation is going to be 297,000, which is the balance of the plan assets right here, times 10%, which is where we're getting the 10% from is right here, this discount rate. And this is going to decrease our pension expense by 29,700 because the plan assets we're saying that they earned 29,700. So the plan assets are worth an extra 29,700, which means now the corporation can use the increase in the plan assets to offset their expenses under the plan because now this money has come from the investment, so we can use it to pay out some of the obligations that we have. Now the interest cost, on the DBO, which is this impact of the time value of money. Now we have to be careful. We can't just use this 255. It's really important that we reflect, that we realize that it's this amount plus this amount here, the 140, because of the fact that this past service cost adjustment happened on January 1st. These both need to be increased for the time value of money. So the sum of these two is going to be 395,400. So this is going to be 395,400 times 10%. Okay, and that basis of this 395,400 is really important. And this is going to increase our pension expense. So this was the impact of the return on our plan assets, but the impact of the time value of money for this extra year, now that we're closer to this obligation, caused an expense, our pension expense increased by 39,540. So from a net perspective, our pension expense increased by 9,840. Okay. And the offset to this interest cost on the DBO is going to be to increase our defined benefit obligation, because as it's getting closer, of course, we need to increase the balance of that amount on the balance sheet of the plan. Okay, so the next thing that we're given is the actual return on plan assets. So we don't adjust the interest cost on the DBO. This is always using just the discount rate that we're given by the actuaries, which was that 10%. But for the return on plan assets, the actuary told us to expect 10%, but we actually got a return of 8%. So we need to adjust the expected return to say, well, we thought we were going to get 29,700, but we are getting less because we're only getting 8% and not 10%. Now, this amount for ASPE goes through pension expense. If we were using IFRS, it'd be really important to realize that this remeasurement loss, which is the difference between the 10% and the 8%, is going to go through OCI. Okay, so this is going to be our plan assets times 8% minus the expected return. So if we put this in here, it's going to be 297,000 times 8%, which is going to give us, as you can see, we thought we were going to earn 29,700, but we only earned 23,760. But we don't want the whole amount there because we're only trying to recognize the difference. I think this should work. Yes, so the difference is going to increase our pension expense by 5,940. And actually looking at these amounts here, I realize my signs are going the wrong way. So the expected return on plan assets, this should be an offset to our expense, because expense is a debit, of course, going through the income statement. So a credit would decrease the expense, and our interest cost on the DBO should be a expense. So it's the offset between these two things. So you can see our expenses are debits, interest cost on the DBO is a debit, and the expected return on plan assets is an offset to the expense. So it decreases our expense and increases the plan assets. The actual return on the plan assets, which we need to fix this formula now, is going to be an increase. This needs to be an expense. Okay, so now we have an expense of 5,940, and we can check this amount by checking the offset of these two amounts. So what we want is an offset to the expense. We want to credit to our expense of $23,760, and we can see that we achieved that here. And $23,760 is 297 times 8%. So the offset of this increase in our expense of $5,940 is going to decrease our plan assets, which of course makes sense because of the fact that, we thought our plan assets were going to be worth an increase of 29,700, but that was too high. So we had to pull it down now. So you can see now we've increased our plan assets by 23,760, which is exactly what we have going through as an offset to our pension expense. Okay, so we picked up the interest rate there, picked up this. It looks like we have all the information. Let's run the totals through our pension worksheet. And I can just run a sum through. Okay. Okay, so we've got our sum running through. So we've got pension expense of 219,180. We've got a decrease into the corporation's cash of 79,200. We've got a defined benefit obligation, the pension plan of 454,740. And we've got plan assets of 356,760. So we do need to look at this net defined benefit or asset or liability. So this is what's going to be reflected on the books of the corporation. So we know that we calculated this amount. Remember, we looked at the difference between the obligation under the pension plan and the plan assets. And we said that on January 1st, there was a surplus in the pension plan of 42,000. Now we do need to update this amount here. So what's happening at December 31st, 2020? Is the plan in a deficit or in a surplus? Well, right now we can see that the pension plan has an obligation of 454,740, but now we only have assets of 356,760. So we have less assets than obligation. So now we have a deficit in the plan. So this net defined asset or liability simply picks up the obligations of the corporation under the pension plan. So we need to update this amount. What are we going to record on our statement of financial position? It's going to be the net of these two amounts. So now the corporation's gone from reflecting a surplus in the pension plan of 42,000. And now at year end, we have a deficit of the pension plan of 97,980. And that is what would be reflected on the statement of financial position, or the balance sheet, I should say, because we're using ASPE here, of the corporation. And the reason that this is reflected on the corporation is because the corporation has promised employees that they'll receive the benefits that are going to cost 454,740. Now, the plan assets aren't enough to cover that, but it doesn't matter. They've given the employees this promise and they have to make good on it. So if the assets are short, they're going to need to make up the difference, and they're going to make up the difference by funding the plan more. They're not going to start paying benefits out in the corporation, but they're still on the hook to make sure the plan has enough money to satisfy this obligation. So let's take a look back at the question and see what we've answered. So the first thing says, calculate pension expense for 2020 and prepare journal entries to record the expense and funding for the year. Okay, so we've definitely calculated the expense for 2020. Now let's do our journal entries. And if you're doing this exam or doing this question on an exam, I suggest just explicitly answering the question. So pension expense for 2020 is 219,180. Journal entry for expense is going to be debit, pension expense, credit, net asset, net defined benefit asset or liability. So our pension expense is here of 219,180. And so this is what's going to increase our net defined pension asset or liability of 219,180. And let's just pause and talk about this entry here. So we know that pension expense is 219,180, but remember that many of our entries that we recorded on our pension worksheet went between the corporation and the plan. Here's an example. Past service costs, we had pension expense and then the DBO. Now, of course, we need to balance our books and records in the plan itself, in the corporation itself. So if we look at our balance sheet here, including the opening balance, we do balance. This balance sheet does balance. So our balance sheet does balance with the opening balance. This is not the balance sheet amount. This would need to include the opening balance there. But so the offset of the pension expense hits our net defined asset or liability. And I'll show you how this reconciles in a minute. So that's the journal entry for the expense. And the journal entry for funding is going to be debit, net defined benefit, asset or liability, and credit cash. And you can see the cash credit here. This was for contributions, remember? Employer contributions. So this is going to be 79,200. Okay. So now if we reconcile our net defined asset or liability, we're going to have opening. We had 42,000. Now we've got pension expense. This increases it because it has a credit balance. So this is going to be this 219,180. Then we've got contributions, decrease it. So then we've got our closing balance of $97,980, which is exactly what we have here. Okay, so we've got the journal entries for that. So next we've got determine the balance of the net defined benefit, a liability or asset reported on the balance sheet. So let's just answer that question. So B, the net defined asset or liability reported on the balance sheet at December 31st, 2020 is a liability, because it's a credit balance, of 97,980. And that's exactly what we reconciled above in this reconciliation. And this is what we had in our column here. And so the net defined asset or liability is simply the obligation of the employer to make up any deficit or surplus, or to take advantage of any surplus in the plan. So you can see that's exactly the difference between the defined benefit obligation in the pension plan and the plan asset. So it reflects the shortfall of the fact that the plan assets are less than the defined benefit obligation by 97,980. And you can see how we reconciled it through our journal entries here. Just talking about these journal entries. So when we look at our pension worksheet, we've got pension expense and cash going through the books and records of the corporation. The offset of the journal entries to these is this net defined asset or liability. So when you've got a debit, you're increasing the liability. When you're decreasing the cash here, then you're decreasing our liability. And you can see how these things played out here. Okay. So now we've dealt with A. So we've done A, we've done B. We definitely have C done. D is identify the December 31st plan surplus or deficit and compare it with the asset or liability reported on the December 31st, 2020 balance sheet. Well, that seems like kind of a silly question, but let's answer it. So the deficit in the plan is as at December 31st, 2020 is 97,980, the same as the liability reported on the balance sheet of the corporation. This is because the corporation is responsible for the deficit in the plan. Okay, C is done, or D is done, sorry. And then E, explain the result of your comparison. And D, I think we just did that. And then F says, what would change if Sunshine Corp applied IFRS instead of ASPE? So let's talk about that. Let's go up here. Now, what would change if Sunshine Corp use IFRS instead of ASPE? So if we had IFRS, of course, we would have a new OCI account here. Now, what would go through OCI? Now, past service costs always go through the income statement under both ASPE and IFRS, so that's not going to change. None of these amounts change. The only thing that would change would be this amount. This is a remeasurement loss. So what would happen here is that we would take this debit and we would change it from here to put it here, 5,940. And OCI is a credit balance, so debiting it decreases it, which is exactly what we want. So now we would have had an OCI, a decrease in our OCI of 5,940, and we would have pension expense going through the income statement of 213,240. That's the only thing that would change between ASPE and IFRS. So this is what it would look like under IFRS. So let's answer that question. So F, we're going to say the only change if we used ASPE or if we used IFRS would be to record the remeasurement loss on plan assets, the difference between the expected return and the actual return of $5,940 through OCI instead of through pension expense. And that is the answer to F. And that takes us through all the answers to this question.